One of the most popular uses of options has to do with hedging. We've talked earlier about how to hedge with futures contracts. Now I want to talk a bit about hedging with options contracts. I'll consider two examples. One, a stock portfolio, and two, a bond portfolio. Now first consider a stock portfolio, very similar to what we considered before. We've got $1 million worth of equity, and it's invested in a portfolio that very much resembles the Standard & Poor's 500 stock price index. And we are concerned about a short-term market correction. As before, we don't want to liquidate our portfolio because we would bear all the transactions costs of selling and bear the transactions costs of buying when we want to get back into the market. So we want some short-term protection for a potential correction in the market. Now before, we discussed the hedge that involved selling the futures contract on the S&P 500. Now I want to consider doing this with options. Well, the first step in hedging is to identify the bad scenario. The bad scenario for us is obviously if the stock market goes down. The second step is to determine what instrument pays us off in the bad scenario. Well, in this case, it's going to be a put option, because we know put options become more valuable when prices go down. So what we will do is to purchase put options with an underlying value in terms of the commodity that the put option is on, worth $1 million. So, what happens? If the price of the stocks or the stock market as a whole goes down, then the put option will pay off. So suppose that the market value goes down from 1 million to 900,000, a 10% drop. If we've structured this put option correctly, the put option will pay off exactly $100,000. And suppose it goes the other way. Suppose the market rises by 20%. Well, our portfolio is now worth $1.2 million. We profit by $200,000. The put option is worthless now. Because the price went up, the put option finished out of the money. We let it expire unexercised. So in this case, we realize the upside, which is the $200,000, but don't bear the downside. So this really differentiates the call option and put option and the long futures and the short futures. If we had done this hedge with the futures, and if the price of the market went up, then we would lose money on the futures that would exactly offset our gain under our underlying portfolio. With the put option strategy, we're protected when the market goes down, but we benefit on the upside. Now, this does not come free. To achieve this one-sided protection, we actually have to pay for the put option. And what I've described is a simple example of portfolio insurance. So buying a put option is sometimes called a protective put option. In this case, when you own the underlying commodity, protects your downside. It limits your downside to a certain level that you set with the amount of put options that you undertake and the strike or exercise price of the put option. The upside is available. The only issue here is that the upside is not as great as it was if you were not hedged, because you've actually paid for this protection. The insurance premium you have to pay no matter what. But this is a simple example of how to hedge with options. Now we can also talk about a bond example. The bond example might be that we hold, again, $1 million worth of 20-year bonds that have an 8% coupon, and suppose the market value is exactly $1 million. Let's identify the risk first. If interest rates go down, is this a risky situation for us? Well, if rates go down, the price of our bonds goes up, so this is actually the good scenario. What about if interest rates go up? If rates go up, then the prices go down and we lose. And for the 20-year bond with 8% coupon, the modified duration is approximately 9. So 1% increase in interest rates would cause a decrease in the value of my portfolio by $90,000. Now, the next step is to identify the security that pays off when the interest rate goes up or the prices go down. And this again will be a put option. So we will want to purchase a put option. And the put option should be on the 8% 20-year bond that's got an underlying value of $1 million. At expiration, if rates have gone up by 1%, the value of the bond in the option contract will have dropped by $100,000, and that will be exactly the payoff on the put option. We are protected. If, however, the interest rates go down and the value of the bonds goes up, then we participate in the upside. The put option finishes out of the money, finishes worthless, but we get the upside. So again, we have this one-sided payoff that protects us in the bad scenario, but we get to participate in the good scenario. The difference, of course, between hedging and not hedging is in the good scenario, when we're hedged, we still have to pay. We have to account for paying for the insurance or for the put option. So these are simple examples of hedging with calls and put options. Now, notice in these two examples, both of them have been put options, but in neither example did we write an option. In most cases, we will be purchasing options for insurance purposes. There are some strategies where you would consider writing an option, but these strategies are concentrated on in the advanced derivatives or the derivatives courses. The safe solution, the solution of minimum risk and maximum protection, is to purchase the option for insurance.